Hello, hello. How is everybody? Thank you so much for joining me, whether you are joining me live or catching the recording. I appreciate it. It is St. Patrick's Day and spring break where I'm at. We've had beautiful weather. I'm in Kyle, Texas right now. Grew up in New Braunfels, Texas. I'm Erica Belay, mortgage loan officer. Thank you so much for joining. Tonight, I am going to talk about refinancing, what it means to refinance, and the buzz about the rising interest rate market, and is it a good time to refinance? So the answer to that is maybe. Maybe it is, maybe it isn't. But in the latter part of the first quarter of 2020, we saw interest rates plummet down to like twos and threes, 3%. Many homeowners and home buyers were able to take advantage of that more affordable lending during that time. Since then, we've seen interest rates increase to a more natural place. And such, we've seen a decrease in refinances. Um, and I guess you could say a decrease to a more natural place as well. I think that the refinance market was crazy during COVID. Like, just everybody was refinancing because interest rates were just so low. So today's seminar, I'm going to cover exactly what is refinancing, what are the reasons to refinance, what does the process look like, and lastly, should you still refinance in this increasing interest rate environment? So, overall, refinancing isn't too complicated. If a homeowner has a mortgage on your home and you want to refinance, it will basically replace the current mortgage with a new mortgage. It's that simple. So, you're taking out a new mortgage on your property. The new mortgage is going to pay off the old mortgage. Now, the new mortgage will have terms that are different from your previous mortgage. These new terms would normally be an improved rate, or you might have a separate purpose for wanting to refinance that would justify going into a mortgage that maybe does have a higher interest rate. For example, um, maybe you want to consolidate debt using a cash out refinance. Maybe you want to do a cash out refinance to do a home improvement project. Um, and so, or maybe you want to change from a uh, 15-year term to a 30-year term, or a 30-year term to a 15-year term. So there's a lot of different reasons why you might want to refinance, and it might not all be tied to the interest rate. You just have to be very mindful that refinancing the mortgage does reset the terms. So if you are 10 years into a 30-year mortgage and you decide to refinance to a new 30-year mortgage, then you're now spreading the new mortgage over the next 30 years. So it's definitely new terms. Another thing I'm seeing is there's a lot of cash buyers right now. The market is crazy, and cash buyers kind of a little bit of an upper hand on the market, but maybe they don't want to leave their cash in that property. Or maybe you've owned your house free and clear for a long time and you want to tap into some of that equity in your house. So you can do delayed financing if you're a cash buyer, or you can do a cash out refinance um, to just get some of that equity and get some of your cash back out of the house. Excuse me. Okay, so what does the qualifying process look like for a refinance? Really, the overall a qualifying process is probably easier than getting a loan to purchase a home, but really it's about the same. You're gonna still submit an application. Um, the lender is still gonna verify your income, gonna verify your credit score. Your credit score will still determine the rates you get, and so the better your credit, the better your interest rates will be. And so in general, though, the only documents that you need for a refinance are going to be, your state issued ID, driver's license or ID. If you're a W-2 employee, like W-2s and pay stubs, or tax returns, and then your most recent mortgage statement. Another thing that's really good to have is your survey. So if you've purchased a house, hopefully you know where your survey is from your original purchase, because if you cannot come up with your survey, then you will have to purchase a new survey. And I think they're around 500, 550 maybe to get a new survey. So it's always good if you have the survey that you got when you purchased your home. Um, Now, if you once you submit your application for a refinance, um, all the documents that I stated are enough to get you to underwriting. When you get into underwriting, then there'll still be title work that will be ordered. You will need to get homeowners insurance. So you have a homeowners insurance probably. So you'll just have to have updated homeowners insurance. And depending on the type of refinance, you'll probably need to get an appraisal. Now, there are two different types of refinances. There's a rate term refinance, which is just to change your rate, change the term. And then there's a cash out refinance. So in a cash out refinance, you're actually taking out a bigger loan than what you owe so that you can get cash back from that refinance. So if you're doing a rate term refinance, an appraisal is not always required. If you're doing a cash out refinance in Texas, then an appraisal will definitely be required. So depending on the type of finance, you may qualify for an appraisal waiver. And if you do, that's great because that'll save you time, not only time, but also money. Appraisals are not very cheap right now, so if you can qualify for that appraisal waiver, it just makes those closing costs and the cost of getting that refinance a little bit lower. And then depending on the variables, whether you have an appraisal or not, you can usually close a refinance anywhere from 14 to 30 days. So we talked a little bit about this, but what are some of the reasons to refinance? First and foremost, most people refinance in order to get a lower monthly mortgage payment. And so that usually means if the interest rates are lower, or if you purchased your house and are paying mortgage insurance, maybe once. So basically, you have to pay mortgage insurance on a conventional loan or an FHA loan or a USDA loan. You have to pay mortgage insurance if you don't put 20% down when you purchase that home. Once you have 20% equity in the home, you shouldn't have to pay mortgage insurance anymore. Now, if you have an FHA loan, you pay mortgage insurance for the life of FHA. So a lot of people will refinance to get out of an FHA loan and get into a conventional loan. And so maybe the base interest rate for your FHA loan might be lower than the interest rates are right now. But if you're paying mortgage insurance, it's possible that even in a rising interest rate environment, that your new monthly payments will be lower because you will no longer have the mortgage insurance payment. So one of the things too, like if you're a real estate investor, getting out of mortgage insurance or getting your payments lower obviously just means more cash flow, right? So if your mortgage payment is lower and you're charging rent, you'll get more cash flow by refinancing into these lower payments. A second reason I already talked about the second reason is of changing the terms of the mortgage or the type of mortgage, like I said, is changing from an FHA loan to a conventional loan. So another reason might be to go from a 30-year mortgage to a 15-year mortgage. And then, as I talked about before, my favorite tool in real estate investing is the cash out refinance. So, cash out refinance, you're actually tapping into the equity of your home. And and basically taking cash out of the home, out of the equity from your home. And so you might want to do a cash out refinance to do a home improvement project. Maybe you want to put an outdoor living space. Maybe you want to put in a pool. Um, Maybe you want to renovate a kitchen or a bathroom. So home improvement projects are a big reason. So I have a lot of borrowers right now who want to do a cash out refinance to tap into that equity, because over the last year or so, the value of your home has probably increased significantly. And maybe you don't want to move, but maybe you can tap into that equity to make your house a little bit more livable. Um, my favorite reason to do a cash out refinance is to purchase more investment properties. I personally, for any of you who've watched my videos before, I've talked about this before, but I'm a real estate investor myself, and I have done several cash out refinances on my primary residence so that I can free up more cash to purchase investment properties. And then I'm purchasing basically another income producing asset. And so even though I am continuing to lengthen the life of my mortgage, so I'm going from one 30-year mortgage to another 30-year mortgage, my interest rates and my monthly payments have stayed about the same, but I've been able to get that cash out so that I can buy income producing assets. So those are just some of the reasons. And so what do you need to know before refinancing? Other than knowing your interest rate, I mean, you obviously want to know what the interest rates are. Um, you want to be mindful of what is your reason. Um, we also want to know what is your value of your property, right? So typically for like a cash out refinance, you can't exceed 80% of your property's value. So if you're going to do a cash out refinance and your home is valued, let's say at 500,000. So if your home is valued at 500,000 and you currently have a mortgage that you owe 300,000, you can borrow 80% of 500,000. Well, 80% of 500,000 is 400,000. So you would take that 400,000, would pay off the 350,000, and then you'd get 50,000 cash back. Now, you probably wouldn't get exactly 50,000 cash back because there would be closing costs and some things, but you'd get around 50,000 cash out of out of the equity from your home. So, um, excuse me. So the cash out refinance is really powerful. In order to do a cash out refinance, the maximum loan to value you can go is 80%. Now, if you're doing a rate term refinance, that's not the case. You can do rate term refinances at higher loan to values, but typically, like if you're getting out of that FHA and into a conventional, you want to make sure that you are only borrowing 80% of the value, because you want to avoid that mortgage insurance. Now, another thing to think about is how long do you plan on staying in that property? An important condition to be able to legally refinance your home is to make sure that it's justified. That means that your purpose for taking cash out of the home is to refinance, either to reduce your interest rate or change the mortgage into one that will save you money. So if you plan on moving within 2, 5, maybe 10 years, you want to talk to your mortgage professional about what's my break even, because there are closing costs. When you do refinance, there are closing costs associated with that. So you want to find out, what is my break even point? Does it take me 1 year to break even? Does it take me 2 years, 5 years to break even? Because if you don't hit that break even point before you plan on moving out of that property, then it might not make sense to do that refinance. Basically, you just want to make sure that the cost of refinancing, that there's time to recoup the cost of refinancing. So mortgage terms to know, I already talked about one of them is LTV, loan to value. So knowing the appraised value of your home or the approximate value of your home and what your loan to value is. Um, but a couple of other things, if you've purchased a house and you're thinking about refinancing, you probably know most of the mortgage terms um, that are out there. But two things I want to talk about are discount points and amortization. So when you're meeting with a loan officer, they should be taking into account your home ownership goals, your desired monthly mortgage payment, your long-term plan for that real estate property. And what you need to know about a discount point is it's the lender will lower your interest rate at an extra cost. So this extra cost is known as a discount point. So one discount point is 1% of your loan amount. Discount points and mortgage insurance are both tax deductible as long as you're doing an itemized deduction. So if you're doing a standard deduction, you can't deduct your discount points or your mortgage insurance. But, discount points in a rising interest rate environment. So rates have been going up. So maybe it'll make sense for you in order to make that mortgage work and make those monthly payments work for you. It might make sense to pay for the discount points to get that lower interest rate. Now, amortization. This is when you have a long-term plan you're putting into place to pay off the loan. The amortization can be seen as a plan that takes into account the interest and the principal payments of the loan. So every time you make a payment on your mortgage, part of that payment is going towards the interest, and part of that payment is going towards the principal loan amount. And the amount that goes towards interest and principal changes throughout the life of that amortization schedule. So you might want to look at that amortization schedule to see, okay, my mortgage payment of $1,200, how much of that is going to interest, how much of it is paying down my principal balance. As time goes on, your principal balance will decrease until the loan reaches zero and you have full equity in the real estate property. It's especially important to note if you're changing from a 30-year mortgage to a 15-year mortgage, obviously the time period of the amortization is going to be lower, but your payments are going to be a lot higher because when you change to a 15-year mortgage instead of a 30-year mortgage, you're going to have to make much bigger payments to pay off that mortgage. So should you refinance with interest rates increasing? It's kind of a shock right now for a lot of buyers and a lot of borrowers when rates have been so low. We got a little spoiled with rates being 2%, 3%. It is a shock when you meet with your mortgage loan officer and you find out that interest rates are in the high 4% and 5% range. But 4% and 5% is the natural interest rate range. And even at 4 and 5% interest, those are still pretty low rates. We've just been a little bit spoiled with the 2 and 3% rates, I think, for a while. But so should you refinance now that rates are 4 and 5%? Well, you just need to be able to ask yourself these questions. Am I needing to reduce my monthly payment? So even with interest rates being 4 and 5%, is that lower than what I'm currently paying? Because maybe you have an interest rate that's 6, 7%. So maybe you can still refinance into a lower rate. Do you need to get cash out of your property? Do you want to change from a 30-year term to a 15-year term? The other thing I want to point out too that I forgot to mention before is that you don't always have to refinance into another 30-year mortgage or a 15-year mortgage. I've got some lenders that will let you, if you only owe 10 more years on your mortgage, you don't have to necessarily refinance into a 30. You could refinance in just another mortgage that only has 10 years on it. So we do have some flex term options for a refinance. So maybe we can look into that for you. Um, do you want to pay off your property more quickly? Do you want to get cash out? Is refinancing going to help you meet your homeownership goals? So maybe you need a professional to help you figure that out. So when you meet with your mortgage loan officer, most of us we have tools that can help kind of compare different rates and compare your break even points and compare some different scenarios for you. So I would love to be the loan officer that helps you with a refinance or a purchase. But when you're meeting with a mortgage loan professional, you just want to make sure that you're meeting with somebody who's going to listen, truly understand your goals, truly understand what your needs are, and lead you in the right direction that's best for you. I would be very wary of some of these. You might see some of these big name mortgage companies who are just going to try to get you through. Like they just want to close the loan, just want to close the loan, and they might not have loan officers that are going to really listen to your needs and help you find the right product and the right mortgage and the right refinance to meet your needs. I would be happy to meet with anybody and do a no cost analysis to see maybe the refinance doesn't make sense for you, and that's fine. I'm happy to check and see, and if it's not right for you, that's fine. It's no cost for you to just check with me and see if it makes sense. Okay. So please reach out. Let me throw my information up there. So let's see, is my information showing? Well, I can't, I'm having some technical difficulties. I cannot get my contact information to show, but I'll just move on and talk a little bit about my company, and then maybe I can get my contact info to show up there in a second. So I work for a brokerage, Best Life Mortgage. Our mission is to help people achieve their best life. It's in the name, Best Life Mortgage. And so we want to provide all of our clients with a first class experience. We empower everybody on our team to embody a growth mindset. And then my favorite part about my company is that we are a tithing company, which means we give 10% of our corporate profits to liberate kids from the shackles of human trafficking. We partner with a company called Destiny Rescue, who basically does all kinds of great things to rescue kids from these horrible situations. They do some covert operations, they do some counseling, they do some job training so that we can help these kids live their best life. So every 7 loans liberates a child. So we would love for you to do your loans with us because we give back to helping children in need. If there's any way I can help you, please just reach out. My cell phone number is 210-279-4392. You can email me at Erica Belay at Best Life Mortgage, or just shoot me a private message or a direct message or a chat. And I'd love to help see if a refinance is makes sense for you, even in this rising interest rate environment. Have a great evening.